on the WAM's website. So those of you who could not attend can access it later on. So thanks once again, Wenxi. The floor is yours.
Right. Thank you very much, Bakers, and also other committee members for organizing such great platform. And it's also great to see many of you here. So this is joint work with Darwin and Zhenyu, my colleagues at the CUHK, and also Hu Lai from Tilburg University. So the motivation for this paper is actually started from this awareness, increasing awareness about climate change for global, for globally for people from different countries. So most people became aware of the scientific consensus on climate change and the call for globally collective actions. For example, the Paris Accord in 2015. Environmental organizations and activists advocate divestment in fossil fuel companies as one of those actions that can be useful and powerful for the long-term goal to control the carbon emission. For example, there are different movements. For example, people set up this fossil fuel divestment day, which is on February 13th, in case you don't know yet. And also there are many climate strikes. So one example, this is a Harvard-Yale football game in 2019. And then at the end of the game, the students from both universities says nobody wins because we are suffering from the climate changes. So, and also institutional investors start to respond to the increased awareness of common, retail investors or, more generally common people. So for example, BlackRock announced that they're going to exit investment in core companies and launch the new ETF products that excluding fossil fuel stocks. Some sovereign wealth fund, Norwegian fund plans to get rid of the coal companies and the fossil fuel companies. And some university endowments, right? Harvard, Stanford, Oxford, and then they have made significant steps to divest the coal and the fossil fuel companies. So there's a report by practitioners saying that there's over 1,000 institutions from 37 countries have committed to some extent to divest from the fossil fuel industries. So this paper is trying to first systematically examine, to what extent financial institutions or institutional investors around the world are reducing their exposure to stocks of high emission industry or companies. And also we want to examine, if any, there's real effects of such, divestment from high emission firms. Right, so this is actually not very clear from ex-ante point. One reason is that when firm gets divestment, the valuation will be lower, right? So for some investors, the firm may not respond because when the price is lower, actually those stocks potentially can earn higher returns, right? So this is clear from the two papers, the recent papers. And also another thing is that some investor is going to divest, but the shares will going to be bought by some other investors, right? So as long as there are some investors are not committing to divestment, it seems that maybe the divestment campaign may not make any real effects on the firms. So what we find actually, first, we confirm that there's a significant divestment by institutional investors around the world, particularly after 2015, right? So we find that relative to the market weight, the total value of the decrease in high emission companies is around $120 billion. And particularly we find that there's a heterogeneity in the cross-section and time series about such divestment behavior. Right, so we find that the reduction is stronger in countries where people are more aware of climate risk. So this is based on some survey. So later on, I'll tell you more details about the survey. So basically asking people, do you know about climate change or global warming? And then different countries, actually, there's a significant surprising, heterogeneity about, to what the fraction of people who understand or have been aware of the issue of climate change. So we find that the divestment is stronger for the country where people are more aware of climate risk, and also more stronger after 2015. So later on, I'll show you some evidence that why 2015 is kind of magic year for the climate change campaigns, right? So in the percents of divestment, so this is about the firm action. So we find that in the percents of divestment, compare with clean firms in the same country, high emission companies tend to first have lower price valuation ratio. So this is likely due to the selling pressures from the divestment by institutional investors. Second, we find that those firms, the high emission firms in the country, tend to increase capital expenditure and also R&D expense compared to the company itself. And they reduce the CO2 emission from their operation. And also they improve the environmental scores, the company's environmental scores in the ESG ratings by different vendors. And most importantly, we find that those high emission firms tend to generate more innovation and patents in green technology, not for all the technology. For green technology, those are the technology that can potentially be environmental useful to decrease the carbon emission or to reduce pollutions. All right, so our interpretation for those correlations is that we try to argue this is due to the carbon divestment generates pressure on firms to adopt climate-friendly policies and invest in green innovation to decrease carbon footprints. Obviously, here's endogeneity concerns. So it's possible that the funding or the correlation is driven by some omitted variables, right? For example, could it be some regulatory policy across a different country that driving people get out of emission firms, and also make the emission firms to transform into a green firms. So our strategy here is that we try to use this differences in differences approach. Is that we try to, because we find that, I will show you earlier, first is that the divestment behavior is more prevalent among the high emission firms in the high awareness country after 2015, right? So this is a very powerful, useful heterogeneity in the cross-section and in the time series. So we try to exploit that as a way to identify the effects. So actually we find that the change in firms' valuation, green innovation, emission actually are under the same direction with this pattern in divestment across different country and across different time. But you may still concern that maybe this is driven by some regulations, right? So here we actually further have a positive that we collect the data on private firms to see whether the differences between public firm, so to see whether there's a differences between the public firm and the private firm, right? So if it's a regulation, if some countries, high awareness country, adopt strict regulatory policies after 2015 that driving the results, actually we should see both public firms and the private firms in that country after 2015 will get the same effects, right? But if it's a divestment channel, actually the effect should be more significant for the public firms, but not so significant for the private firms, because private firms don't really get the pressure from the divesting investors, right? So actually we find that actually there is indeed a differences between public firm and the private firms in those countries, right? So that is more, we think is more consistent with the divestment channel rather than the regulation channel. All right, so before I move into the data, if there are any questions or?
I have a question. Hi, Wenxi, this is JP Gomez from Madrid.
Hey, hey.
So one question, do you know anything about the explicit incentives that CEOs from these quote unquote clean companies may have to actually tackle this issue? Because besides this public pressure that you're talking about, there is a growing, presence of ESG targets in CEO compensation. Have you heard anything about this, collected this information?
You mean there's a setting up, so there's the board is setting up the ESG target for those.
Yeah, in particular,
Yeah.
regarding carbon footprint, right? So it may be that, you're capturing their, clean companies are clean because the CEOs have incentives to be clean. That's what I mean, explicit incentives.
I see. Yeah, we but I think because the target is set by the board, right? The representatives of the shareholders, right? So I think it's broadly aligned with this pressure from the general investors or institutional investors that are holding that company. Because institutional investors like BlackRock particularly get also those university endowments get a lot of pressure from their stakeholders, right? So I think this divestment probably is one way. I think there's another thing people talk about is called engagement, is that I still hold the high emission firms, but I lay out the plans that can help the high emission firms to reduce the emission, right? So there's different ways to do that. I think you mentioned it's a target thing for CEO is definitely one of the ways, I believe, to putting the target into the compensation formula for the CEO. That will give the CEO real incentive to do so. I think also like some shareholders try to propose different proposals in the board and make the company to pass. That's another way, I think, to sort of like engage into the high emission firms to lower the emission. But divestment is another way. I think those two engagement with this divestment are two ways that sort of complementary to each other. Yeah. But I think that would be something interesting to look at that. Yeah, but that's more like in this engagement approach. But definitely engagement, I think, is also quite relevant and important, and a lot of people are talking about that as well. Yeah.
Wenxi, just to add to Juan Pedro's comment, I think I did a paper recently where we looked at institutional pressure on firms' innovation. And one of the tests we did was to look at CEO compensation and see if they are actually, because if the pressure story is true, and there is a huge divestment from institutions that are unhappy, then the CEOs who are more vulnerable to a drop in the stock price because they get paid option, equity-based compensation, you should see a bigger effect. You can also, in that paper, we also looked at turnover performance sensitivity as well, and how entrenched the CEOs are. So you could actually exploit the heterogeneity in the vulnerability of CEOs to institutional pressure in some sense.
That's a good suggestion. Yeah, we'll take it now.
Yeah, go ahead.
Yeah.
So I had a couple of comments. One was that, what do you kind of assume about the efficiency of the financial market before the intervention of the financial institutions? So in some sense, you're saying that the prices actually adjust after after these institutions intervene. But do you have a sense of like what, is there some kind of inefficiency that they are trying to remove by engaging with the firms? So that was one thought I had. I had a couple of other things as well, but I don't want to take too much time and maybe ask you some things later on.
Right. So you mean the efficient? So the
price. So essentially, like, I think this is one of the issues in the literature, as I understand it, that if you think that there is a firm that is polluting the world, then the price should automatically adjust for such kind of behavior. In which case, why should the price actually change with the intervention of the institutions? So I'm trying to understand, is there the underlying assumption that somehow the prices do not fully incorporate the polluting behavior of the firms.
You mean when the firm is polluting and the price should be low, right?
Yeah, so it should be.
No, but that's based on the assumption that the investor are caring about the pollution, right? Caring about the negative externality. But if the investors really care about the returns, why they should give the lower price to the company? That's not very clear.
Yeah, so that's what that was my question. So in fact, you're saying that basically there is some, the price hasn't quite, because the investors don't care in certain cases, and that's where institutions come in, drive.
So I believe it's an empirical question, because there are some investors care about the environmental issues. There are some investors don't really care. So it's really an empirical question whether the price, is reflecting the negative externality. But I think those two papers, or also some early papers on those scene stocks, showing that there, those concerns matters for the price, right? So those the companies that are generating negative externality are undervalued compared to the comparables. Right? But this is definitely not a good thing for CEO, because the price is not good, right? So that's generating pressure on the management of the company. Yeah.
And on a related note, the financial institutions are delegated managers themselves. So is it driven by their own preferences for these things, or it's driven by their own investors who want to see this behavior?
I think it's driven by the stakeholders, right? Like students, like retail investors, right? So you can see if you I don't have a figure here, but if you just easily plot the size of the ESG ETF pretty much across all the countries, like from China to US to European countries, the size of those ESG vehicles just increased very, very fast in recent years. And most of the investors to those vehicles are retail investors, right? I think the retail investor. So that's why we think the awareness of common people it's a driver. So people starting to realize that, oh, this is something real, matters for my kids, and we should do something for that. I think that's something driving everything here. I don't think it's institutional investor itself are really caring about that. But nowadays, those bigger guys are obviously doing a lot of things. Yeah.
Hey, Wenxi, I have a quick question. So I'm thinking on the financing side of the equation. So these bad companies that pollute, this divestment, their prices go down. That makes the financing of the good things they're going to do in the future more expensive.
Exactly.
So that's a little bit counterproductive, right? Is that the idea?
So that's exactly. This is a very good point. So actually, so maybe we don't have this in the slides, but we do have that table. Is that we try to answer the question. Those guys try to invest more, and particularly invest more into the R&D and the innovation. We want to see like where they get the money from, right? Because nowadays the pricing is low, means that the equity financing became more costly. So actually we find that we don't find any evidence they financing from equity or financing from debt, because we don't see those firms increase equity issuance or debt issuance. So we infer that probably they get the money from the internal cash flows, which makes sense because obviously the external financing costs increase because of this negative imaging thing. So they try to use the internal cash flows to finance that.
So Wenxi, on that note, I also thought that it's also not clear that private firms are totally immune to the pressure, because if they need money from the VCs, and if VCs care about or other institutional investors in the private firm, if they want that, then they could also, I understand that there is no pressure on the stock price per se, but I think there is, of course, the need for financing for private firms still.
I think there's a difference, but I'm not saying that there's no pressure at all for private firms. Another thing is that those high emission firms are kind of like those old technology firms. They don't really deal with too much with those VC or PE. So those are kind of the kind of old technology has been there for many years. So there's so I guess even I do agree with you. I think there are recently some paper showing that the VC and the PE also setting up those targets for the firms. Yeah, but I believe those high emission industries are less subject to such kind of pressures because they don't have the new technology to get the PE or VC funds. Yeah.
Thank you. I'm going to shut up and.
All right. So good. Okay. So data. So we managed to merge quite a few data sets together to do the analysis. So we first get the quarterly holding data by institutional investors from FactSet. So they have a good coverage. They cover in 26 countries. We use the data from 2010 to 2018. For the US institutions, we just use the 13F. For the 26, we don't have China actually. So one thing we are planning to do is getting the Chinese institution data from the Chinese source that we can get one more country here. So this is based on Gallup's survey across 111 countries. This is actually in 2010. So this is before pretty much everything. They ask people a very simple question: how much do you know about global warming or climate change? And then they calculate the percentage of people who responding something or a great deal about it. So the global average is about 76%. This is low actually compared to the scientific consensus. So that's a paper on Nature, I think around 2000. The scientific consensus on climate change is 99%. So this is still far behind the scientific consensus. We got the firm fundamental information. So those are for the, I believe those are for the public firms from DataStream, WorldScope, and the FactSet fundamental. For US firms, we get from CRISP and Compustat. We get, so the ESG, we also have the ESG rating data. So this is from the data set called Rapid Risk. This is a news-based measure. So it's counting the negative news on those ESG issues for the company. So which is different from those other ratings, like MSCI rating, which are based on the industry. So the good thing with this is an absolute measure. So this is a measure in the absolute level, right? So they does not do any adjustment for the industry. But if you're using the MSCI or the things, is a black box. That's number one. Number two, they also do the industry adjustment. So actually making the analysis more noisy. So that's why we think this, we use this one. So we focus on the E issues, environmental issues. So the issues have subcategories: climate change, pollution, ecosystem, waste, and animal mistreatment. Right. So if the company ever have any negative news covered by media, NGO, or government bodies on those issues, the company will have one record in this database, and then we just count the number of records in the database as a measure for the ESG scores. The patents data, firm level patent data, that's from Orbis IP. This is a very good database, very comprehensive. So they provide global patents applications, filed to 94, different patents offices. Include the patents filed by both public and private companies since 1850. So the vendor even showed us there's an application of a steam engine in the database. That's the earliest patents you can find in our human history, I believe. But we don't count all the patents. We only count the so-called green patents. So this is based on the international patents classification. We follow this paper by Cohen and his co-authors to identify the green. So green patent are those that will be helpful to improve the environment and also to lower the emission, lower the pollution, all the things. And we also have the emission data. That's from CDP. So this is a firm level emission data, and then it's basically it's an estimation about firms' CO2 emission in tons on annual basis. And then they have 3 scope 1, scope 2, scope 3. So scope 1 is the emission from the direct emission from the operation. Scope 2 is the emission from the indirect emission from the generation of the purchased energy, right? So if you buy the gas to generating for your production process, so that will be scope 2 emission. Scope 3 is the emission from the supply chain. Okay, so according to the paper by Patrick and Marcy, they find that scope 1 and 2 are more reliable estimates from the database. So we follow that. We use the scope 1 and 2 divided by the total assets. So it's a quite standard way. But I have to say there's a limitation of this database. So they don't have very good coverage when we do the international. So later on, you will see the sample size when we have this test, actually it's relatively small. So we are trying to get the money to buy another one, true cost, which may cover potentially much more firms. All right, so how to identify the high emission firms or industries? So we use this emission categorization by the Intergovernmental Panel on Climate Change. So this is 5 categories: energy, transport, buildings, industry, and agriculture. So those are the main major emission sources based on industry. So we hand match the subcategories in the 5 with the industry classifications provided by data stream, right? So and then the firms in the matched industry will identified as high emission companies equals 1, and then the rest of the firms will be considered clean firms, right? So this is following our own RFS paper. So how to measure divestment? So we try to do this at the portfolio level, at the institutional investors portfolio level. So we calculate the portfolio weights for each institution J at the quarter T. We calculate the portfolio weights in emission firms minus the portfolio weights minus the market weights of those emission firms, right? So if the institution is an index fund, for example, the carbon ratio will be 0. So it means that the portfolio weights on the high emission firms is the same with the market weights, right? So and then if the ratio is positive, means that they overweight on high emission firms. If it's negative, means that they're underweight. Okay, and then we try to calculate the country level carbon ratio, right? So because different institutions may have different preference. Maybe this is energy fund, this is like some ESG ETF, right? So we try to average out across each country as a measure for the divestment. So we take the country level average across all institutions in that country, weighted by the AUM. Okay, so this is pretty much the average of all the institution investors in that market. So here you see that this is a global average. Okay, so 0. Remember, 0 means that we hold the market portfolio. Okay. So the carbon ratio, you can see this is a sample period from 2010 to 2018, right? So you can see that before 2015, the ratio is close to 0, but slightly higher than 0. So it means that people hold a little bit more those high emission firms. But there's a sharp decrease from 2015, and then the ratio sharply decreased to about negative 1%, right? So after 2015, firms, on average, institutional investor divesting underweight emission firms. So the divestment is about 1%, from positive 1% to negative 1%. So why? Yes.
Can I ask a question? Hi.
Yes. Yes. Look.
If you have all investors in your data and you aggregate them, they hold the market by definition, right?
Yes.
So is it fair to say that this is a measure of relative divestment? It's the divestment of investors in your data relative to investors that are not in your data?
Yeah, it is a investor in our data compared to the investors are not in our data. So we don't have retail investors, and we don't have block holders. So our sense. So based on our earlier paper, we actually find that the retail investors are the one reacting to climate shocks, but the block holders normally is the one buying. Yeah, so I don't have any evidence, but my speculation is that probably when the institutions or retail investors divesting high emission firms, the block holders will be the one buying the shares. Yeah, that's my guess, but definitely this is a good point. So yeah, definitely someone will be overweighting. Yeah, but probably will be the owners of the company. Yeah, they're trying to. Yeah, it's the last resort, I guess. Right. So if people selling your shares and you think your company is doing good, and yeah, and then they are buying. Yeah.
Can I ask a question, Wenxi, following Luke's comment? There is a fair amount of heterogeneity in the benchmarks of these institutions as well. I think the example that you gave of an index fund is where they are just tracking the overall market. But I was just wondering how the heterogeneity in the benchmarks can also how that's going to affect the measure, because I can imagine, like, if you are a socially responsible fund, you have a very different benchmark than somebody who is.
So the thing in our mind is that those things were driven by the AUM, right? So AUM is the fund investors, right? So if the funds, like, no matter what target you have, right? But if the fund is getting large in AUM, means that there's more demand. So we do aware, let's say, heterogeneity in the targets but I think when we evaluated by AUM, I think it's a good measure about overall what's people's attitude, right? So if there's more AUM, more flows getting into the ESG fund, more flows getting out of the energy funds, that's already something saying that. So the divestment here, you should not interpret this as a divestment by institutional managers. Actually, this is actually part driven by institutional trading, but partially also driven by the flows that is from the retail investor.
Yeah, interesting. Because even the benchmarks change over time. So I think that kind of introduces some issues with the measure. I was thinking, like, how that's going to change it. So yeah, but yeah, I'll think more about it. Thanks.
Wenxi, I have a quick question on the timing of this fall. This seems to follow directly. I think there was a massive fall in crude oil prices, maybe just before this period. So I'm just wondering how much of this is actually driven by some sort of change in taste, and how much of this is just economic convenience being masked by a change in taste.
Changing in what? In taste about the oil firms? Because oil.
Sorry, yeah, change in taste as in change in investor preferences versus.
Oh, it is.
So in 2015, oil prices fell from maybe 100 to 40, right? There was a massive collapse.
Yeah, so it is a change of taste because we argue this is a divestment from the high emission firms. It is a change of the preference. But one thing I can say is that the figure is not driven by energy firms. If you're looking at the other four categories, transport, construction, industrial, and agriculture, we find similar effects. So this is not driven by just energy firms. Good. Okay, so what are we trying to do for our task to identify the effects of such massive divestment from emission firms? We try to proxy the tendency for carbon divestment using the awareness, right? So our argument is that the country with higher awareness tend to, ought to have stronger divestment over the next 10 years or 20 years. A good thing with the awareness measure, the survey measures, they can cover much more firms compared to the carbon ratio we show. So they can cover 69 countries. And particularly, we think this is a sort of an ex-ante measure that you can ex-ante to estimate how much pressure you will get from the investors. Because when people announce the divestment, because the carbon ratio is a realized divestment, but when the institutional investor, for example, like Norwegian sovereign funds, when they announce their divestment plans, actually the plan will take like 20 years to realize. So we think that maybe that's not a good way to, it's maybe not good to use the realized measure rather than this sort of the ex-ante measure. So carbon divestment became pervasive in the later period, as we show, from this later period in our sample is 2016 to 2018. So there are some, obviously, people discuss, 2015 is kind of a year that people suddenly wake up about the climate change issue. I think the most important event globally, obviously, is the Paris Agreement. That's, it's a global collective action that to combat climate change. But also on other things. So one thing I think is interesting is that there's the report saying that the divestment campaign went mainstream in 2015. Assets tied to institutions committed to divestment had a 70-fold increase from 2014 and 2015. Sort of that's the year that different institutions start to claim we have at least some commitments to this divestment or ESG investing. So this actually motivated us to have this diff in diff, triple diff. So divestment effects on firms' actions should be stronger for high emission firms, not for clean firms, in high awareness country in the late period. Okay. But we also have some, this is our baseline specification based on awareness. We also have an alternative specification that is the change on the firm level carbon ratio, right? So the firm get divestment by institutional investors between early versus late. We also find similar effects, but this is only available for 25 countries because this is based on the holding data that does not cover most of the countries. All right, so first, this is another validation test. We have a 90. So this is we have 20, 30 countries. We categorize into two groups. There's a high awareness country. So those are like Japan, 95% of people realize this already. This is a no awareness country. The relatively less people in the country, aware climate change. So you can see that before 2015, the level, the carbon ratio, for the high awareness country is slightly below 0. Right, for low awareness is slightly above 0, right? So this is consistent. Also, the diff in diff variance is also consistent, right? So after 2015, high awareness country actually we observe even stronger divestment compared to the low awareness countries, right? But we, yeah. So that's the gap. So this is the diff will be the power for our identification. This is a regression analysis that basically replicated the figure, so it's the same. All right, so getting to the main results. So the first result is on the price impact, right? When the firm getting divestment, whether the valuation will be lower. So this is a firm year regression. So we have the PE ratio for each firm at the year end. I will take a log. So we regress on the indicator of the high emission firm, dummy variable for late sample period. So this is a 2016 to 2018, and also the country level measure for awareness. Okay, but here we control time fixed effects and the firm fixed effects. Okay, and then we cluster the standard error by country and by year. Okay. And then obviously the variable, the coefficient of interest is the triple interaction term, right? So it's right here. So the coefficient is negative, significant. So it means that if being a high emission company in the high awareness country, in the later sample periods, actually the P ratio will be decreased. So in terms of the economic magnitude, if the awareness, climate awareness increased by 1 standard deviation, so 1 standard deviation is about 20%. So it means that 20% more people, citizens in the country realize, this is an issue. Actually, this is associated with 5% to 6% decrease in valuation for high emission firms in 2016 to 2018. So we consider this is quite significant effect, 5% on valuation. All right, so actions.
Wenxi, can I ask you a question about the previous table?
Yes, please.
So there is the late times high emission interaction is positive and significant. How should I think about that?
Right, so this is saying that the late sample, this is so you can think of this is this is a effect in the country where the awareness is very low, right?
Yeah, but
the thing is that the minimum of awareness is not 0. So actually, I think the lowest awareness is something, maybe I don't remember, something around like 50%. So you have to do a little bit of calculation here, I guess. So if you times the minimal of awareness like 0.5 here, actually the coefficient would not be that positive, right? So here is the effect for awareness of 0, but we don't have a country that with awareness of 0.
Yeah, I mean, what I'm trying to understand is why is the price higher for those countries where awareness levels are 0? I mean, that's what I'm trying to
we don't have a good story. That's a good, probably we need to think a little bit more. But when we noticed that, we were thinking because the awareness, if you apply the range of the awareness, even for the lowest awareness country in the sample, this term does not have a very significant effects there. So it's not saying that in those low awareness country, the high emission firm in the sample period actually get a higher valuation. Yeah, but we need to think more about it.
I think it might be useful to provide a univariate table as well. I think just to give a sense of how, just splitting it based on high emission, low emission, low high awareness and previous period and late period to just understand what's like going on. I think I'm thinking about this, and interaction terms are kind of tricky to think about. So
yeah, that's fair enough. Okay, and right, the second one is actions. So we look at the capex and R&D, and also CO2 emission in tons. We scale those by total assets, but the results is robust. We scale by other things or revenue, market value. So here with that, because those ratios may change a little bit over the time, and also a little bit being reverting. So particularly for R&D, so what we do here is that we calculate the average of the ratio in the early period and also the late period, right? So we have 3 years in the late period and then 6 years in the early period. So we take an average and then we calculate log change denoted as delta, right? So for each firm, we have one observation. So this is measuring the percentage change in the average, capex ratio late versus early. Right, so okay, so we already have one differences here, and then so here we only have 2 differences. So there's a high emission firm times the country level awareness, right? So the results is here. We find that for capex, right? So you can see that high emission firms in the high awareness country tend to increase their capex, increase R&D, and decrease emission, so decrease the CO2 emission, at least for scope 1 and 2. But we don't want to overclaim these results. As I mentioned, the CDP data, the coverage is not very good. So after merging with the with our sample, we only end up with 1,000 firms. So we don't want to overclaim too much. So we are working hard to get another data set. Hopefully we can get more observation on this. But for those accounting variables, we can see that those are consistent with our stories. So economically, this is also significant. But obviously the caveat here is that even they increase the capex, they increase the R&D, so those are very rough measure. We don't know exactly what they do, right, with this. So that's why we need more accurate measures that is directly related to environmental issues. So the first one we do is ESG scores. So this is, as I mentioned, this is a news-based ESG data, right? So the data is from 2001 to 2019. So they categorize the issues into high, medium, and low severity levels, right? So we still do the same thing, right? So there's the average of post minus the average of in the later years minus the average in early years. But here is that we have to do the dummy because there's no too much variations because many firms actually are reporting zeros in the data sets, at least for those environmental issues, because they also cover some other the S and the G issues. So for many firms, actually, the environmental issue has zero observations, zero. So we define if you have a high severity issue increase from late to early, and then we make this variable equals 1, and otherwise it will be 0, right? So you can see the mean here actually is very small. It's only 1% of firms that experience increase in the issues. We also play around a little bit with different severities.
Is it just me who is seeing Wenxi is frozen, or everybody's? I hope it's not because of my internet connection.
No, it's me as well.
Okay, I think there's some issue in.
Indeed, to get rid of those trend thing, by many reasons. Is there any is there a question? Sorry.
Wenxi, I think you got frozen for a few seconds, I guess. So we didn't quite hear you for that time. So maybe you want to just go back and maybe start explaining the point that you were making. He's again frozen, I think. Darwin, you may have to be ready to present the paper now.
Yes, I'm ready. I'm here. I'll wait for a few moments.
Right. So
he's back.
yeah, you are Wenxi, you're muted.
No, I'm not muted. I mean, I think
Your internet connection is not stable.
Yeah, but it's weird. This is
So right now, okay, so it's again
almost midnight in Hong Kong. Busier. Is it better?
Yeah, I think it's becoming. You become the twinkle twinkle little star right now. So I think you brighten up and then you go away. So hopefully it will be fine. But we'll continue. Otherwise, if it continues, as I told Darwin to just get ready to present the rest of the paper.
That would be good backup. Okay. All right. So yeah, I don't know where you guys get lost. So we have 3 measures for the ESG. Basically, if the ESG score getting worse, actually the variable will be 1. Okay, and we have a different weighted, using different severity levels. Okay. So the issue is that actually you see there's an increase in the overall, because the number is positive, right? So it means that more firms get more issues. This is a part, we're still trying to understand why this is the case, but partially it's due to the coverage of the firm. So the database probably covering more news and sources in recent years. So that's why you see more negative news, because they don't have a positive news in the database. So that's why we have to do this diff in diff to try to get rid of any those confounding trends. Okay, so we run the logic regression.
Can I ask you a question? So based on my understanding of this data, I think there is this issue of truncation or censoring, because you're only looking at negative news, and as you kind of already alluded, so that can actually create some issues here. The other thing I was thinking about is that rep risk relies on media coverage, and media coverage can be correlated with the awareness, and how seriously different, because there is a lot of heterogeneity in the extent to which the media actually considers these environmental issues seriously, right? So, and we know that media coverage can also be influenced by the polluting firms themselves. So there's lots of like issues. And the other thing that has also been shown is that they treat domestic firms and international firms, foreign firms, differently as well. So that's possible that they might say, so if it's a Chinese firm, they might be more, they may not report it. So I have a student who actually used this data for multinational firms, and
I see.
she looked at whether they export the behavior when a firm from the US goes to China, let's say, how do they behave at home versus abroad? And so I think there are some issues with the rep risk data that you might want to think about that could also help, I think.
Yeah. We definitely, those are good points. We were looking into it because we noticed some of the issues, but we thought hopefully we can have this triple diff can help a little bit. But I agree with you. We definitely need more work on that. So we noticed a little bit because this is particularly the truncation thing, because they only cover negative news. So that's something we need to be more careful. That I agree with you. So that's why we somehow think that later on I'll show some patents results. We think those probably is more reliable, given the data quality. All right. There are some issues, but the results nonetheless is consistent with our interpretation. So we find that the high emission firms in high awareness country, they tend to have less negative news in later sample period. Okay, so that's so means that they relative compared to the clean firms in the same country, they have better track record in terms of those environmental issues in recent years. All right, so this is the last part of the results, but we think this is the most interesting part in our opinion. So this is a green innovation. So we try to look at their patents application for those firms. So this is a very nice data offered by Orbis IP. The nice thing is that they including a lot of the patents records, and also they include both public and private firms. And also they do have some accounting information for those private firms that can help us to do the matching. So we categorize the green patent following this paper. So presumably for our test is that the public firms are more subject to divestment pressure, whereas private firms subject to less divestment pressure compared to the public firms. So we expect that public high emission firms file more green patents in high awareness country after 2015. But weaker results for private firms, right? So this can helping us to distinguish whether this is a divestment channel or it's the regulation channel, right? So some papers argue that after 2015, in some countries, actually there's more and strict regulation on emissions on those pollution firms, right? So this may also drive in the results, but that regulation should apply to both public and private firms, but divestment should be more, pronounced for public firms. All right. So first, look at the measure here.
Can I ask a quick question? So do you have emissions data for the private firms as well? Like, can you see if their behavior changed after?
What data?
Emissions data.
Yeah, we have the data for like 100 firms after matching.
So I was wondering why you only look at the innovation and not like their
No, the problem is that we hope we could do that, but the problem is that with the private firm, the matching is even worse than this.
Okay.
So if we get the true cost data, and then if the CUHK can pay for that, we get the data, we will definitely check that. Yeah, so because we already matched, and the match is like a crazily bad. It's only have 90 firms that we are comfortably think they are exactly the same firm, but that sample is just too small for us to say anything yet.
Thank you.
And yeah, so we define those measures. So we again, so because the change is not very big, so we have to use this dummy variables. So we calculated the green patents at the ratio of the total patents for the company, and then we calculate the ratio for early period and also for late period, right? And then we define this dummy variable equals 1 if the ratio increase. And we also look at the absolute number of green patents, right? So if the green patents number goes up, this is 1, otherwise it's 0. And also we have another variable called the 10 green. So it means that the firm has no green patent in early period, but file at least 1 green patent in the late period, right? So you can see that for public firms, this is summary statistics, 5% of them actually file more green patents in later period. But if you look at the matched private firms, the ratio is much lower, right? So the green, the definitely based on this very simple comparison, you see the public firms actually are more active in developing those green technologies. All right, so we run the logic regression, and then we have this interaction term here, right? So here we see the interaction term is positive, right? So it means that the high emission firm in higher awareness country are more likely to file more green patents in the later period, right? So for different specifications, we get consistent and robust results, right? So in terms of the economic magnitude, we if we increase in the awareness by 1 standard deviation, so 1 standard deviation is about 20%. 20% more people think this climate change is important, is there. This is associated with 0.7% increase or to 0.9% increase for high emission firms in those ratios, right? So this is about the 20% of the average, right? So we think is sizable. And we do the same thing for the private firm, but we have to do the matching a little bit because there's a huge size differences between private firm and the public firm across all the countries. So the matching process is the following. So first, we require both public firm and the private firm have at least 1 patent in the whole sample period. Okay, if they don't have any patents, it's not going to be matched. Number 2, they have to come from the same industry in the same country. Okay, and also they have to be close or comparable in terms of the size, right? So we have to so we keep the private firm whose total assets is the closest to the public firm. So not surprisingly, because this is kind of high bar. So actually for 23,000 public firms, we only end up with 8,000 firms that we find valid. We think it's reasonable match. Okay. So what we do here is that we first run the same regression on the matched public firms. So this is a matched public firm. So you can see this is only 1/3 of our sample size, right? So even for this smaller sample size, the results are still significant, right? So the high emission firms in high awareness country tend to have more green patents in later periods. But if you look at the private firms, right? So the coefficient are not statistically significant, right? So this one is a little bit still large economically, but for the other 2 specifications, is much weaker. It's not significant, right? So this is a consistent. Again, we think it's consistent with our divestment channel rather than the regulation channel. All right, so we have another specification because some of you, may concern that whether the country level measure is driven by something else. So actually, we have this firm level divestment measure. So the idea is very similar. Is that we calculate for stock I, we calculate, we look at all the institutions in the market in this country. We calculate the portfolio weight for all the institutions aggregate together minus the market weight. Okay, so this is stock level. Okay, so this is the market adjusted portfolio weight for stock I at quarter T. And then we measure the firm level divestment at the change from late average in later years to the average in early years. Okay, so this number is changed. So if they hold more in late and then hold less in early, it means that they increase, right, in the firm. But if the number is negative, means they divest, right? So for the ease of the interpretation, we'll still use a dummy here. So we rank the change delta weight. So if this one is in the bottom quintile of all the firms, so this divestment will be 1. Okay, but this does not really matter. We can use the measure directly, or we can use different cutoffs. So the results are still there. But we think this is a little bit easier for interpreting the coefficient. Also do the plots. Yeah, so we have the plots here. So so you see that those are the stock level. Okay. We have a blue bar here. Those are the low emission firms. The red bar here are high emission firms. We have the low divestments. Those are the firms does not experience any divestment. Those are the firms do experience significant divestment. And then y-axis here is a turn green. So it means that the firm that does not have any green patents before, but file at least one after 2015, right? So you can see that the average, high emission firms file like 4%. 4% of high emission firms have the records. But you see, if the firm getting divestment, actually the ratio increased to about 6-7%. So there's a significant effect on fighting the green patents. And then for the low emission firm, you can see that the effect is not significant. We run the regression, right? So the coefficient of interest is the interaction here, right? So it's high emission firm, when they get more divestment, they're more likely to file green patents in late sample periods. Economically, divestment, so you remember divestment equals 1 is 1 or 0, right? So divestment, if you get a significant divestment, this is associated with a 3.5% of chance to increase 3.5% more firms actually file green patents. But there's also the heterogeneity. So one thing here is that we control the country fixed effects here, right? So remember, this is a firm level measure. So here we can actually control the country fixed effects. So when we control the country fixed effects, actually in the same regression, we can look at the heterogeneity across different countries. So the economic effects on average globally is 3.5%, but then there's a heterogeneity across different countries. But you can see even for the least significant country, the effect is positive, right? But for some countries, the effect is quite significant. All right, so I think that's all I have. Yeah, that's the divestment results. So you see firm get more divestment. For high emission firms, they are more likely to file green patents. All right, so that's all I have. So let me conclude. Afterwards, in case you have more questions, so I'm happy to answer. So we find that first, there's a significant divestment behavior by institutional investors around the world after 2015, right? So the investment amount is about $120 billion US. That's definitely big. This effect is stronger for countries where people are more aware of climate risk, and also after 2015. We exploit this heterogeneity in divestment patterns, we use this triple diff approach to identify the effects. We find that in the percents of divestment, high emission firms tend to have lower valuation ratio. They increase capex and R&D, reduce CO2 emission, improve ESG scores, and most importantly, we find very strong evidence that they file more green patents in the late summer period. Right, so that's all I have. If you have more questions, we can discuss more. Thank you.
Thank you, Wenxi. Good job. Yes. I had just one comment. I think one. So how do we know that the institutions are sort of threatening the firms to divest, as opposed to just they are just getting out of the firm for other reasons? I was just wondering, like, it's in some sense it's sort of hard to know what their intention behind their divestment is.
Yeah, I agree with you. For the firm level analysis, it is hard. Yeah. So but something we think is that if it's for other reasons, the firm get divest, people just selling the company. Maybe people think the company is going to be really performing really bad. The business is not doing well, and people selling that. Will be weird to see the firms actually try to invest more in innovation. But I agree with you. That's why we put the firm level evidence at the end, because we don't think in terms of identification, it's as strong as the country level analysis, because we indeed don't know what's the driver. Yeah.
Yeah, so one thing that we did in my paper on institutional pressure is we kind of try to find some anecdotal evidence to suggest, like, if you can show that, there was some kind of engagement with the firm. And I mean, it's hard because a lot of this happens behind the scenes, but like, if you can find something that would actually, I guess, help in supporting your story. And the other thought I had was that you could do entropy balance matching for public and private firms. That will probably improve your the power of your test a little bit, because if you do one-to-one matching or something, you might actually be losing a lot of firms. So,
you mean for the firm level result? For the firm
yeah,
level
for the private versus, you do the private and public firms. So I thought that you could use like a.
No, but this one we cannot do that because you.
No. I'm not talking about this one. This is I'm going.
Oh, yeah. For the earlier test, you mean putting the private and the. Yeah. That definitely. Yeah.
Yeah,
that will help you. Yeah.
Yeah, I'll send you the comments anyway separately. But I'll usually we hang around for a few minutes if people want to chat with you. If you're around, I know it's pretty late in Hong Kong, so I don't want to impose any more costs. But thank you again for presenting your paper. And if there are any questions people can ask. I'm going to stop the recording at this point, so you can, and I'll send you the